Well, good afternoon, traders. We're closing out the Friday afternoon session here in Asia. We're looking ahead at the event risk that's going to drive next week. I suppose we'll take a bit of a back step and just have a look at the week that was. It's very much been a dollar play. The strong dollar is causing some issues. Certainly you're seeing that in the emerging markets. Have a look at the JP Morgan Emerging Market Cash Index. You can see that trading at multi-year lows. This strong dollar is really impacting the emerging market trade. Certainly on the breakouts we're seeing in things like dollar Kiwi, dollar Brazil. The fact is, if it wasn't for the fact that bond yields were so low, especially negative real rates, emerging markets would be getting taken to the woodshed. But certainly the strong dollar is resonating. Have a look at it against G10. You can see it up against every G10 currency, although dollar CAD's fairly flat. You can see that's pretty much unchanged on the week. But you can see against the Scandies that the dollar's had strong appreciation. It's certainly against the Swedish krona, up 1.9%. Dollar's rallied 1.8% against the Noki. And we've seen some big moves against the New Zealand dollar, which is trading sub 63 cents at the moment, lowest levels in about 4 years. Aussie dollar has had a small decline of about 0.5%, which is quite interesting considering is what we've been seeing from things like construction, what we've been seeing from the capex numbers, also from the building approval numbers. But that is getting down into the sort of lower areas of 76 cents where we've seen really big buying support. Will we see that breakthrough next week? That's something we'll be looking at. But certainly that dollar, and have a look at the dollar index getting into that sort of multi-year highs at the moment. The question is what will happen with intervention? We have seen Stephen Mnuchin talking about a low possibility of intervention for now. A lot of traders are talking about that and what that could mean for potential currency wars. We've got our red flags, I suppose, with dollar index, I think, into 103. If we saw euro dollar through 105, dollar CNY, CNH materially higher from these points. And it's the rate of change, of course, we looked at. But if we get a sense that the Fed and the US Treasury Department specifically are going to look to intervene by selling dollars in the open market, which is why we're looking at these charts, then we can start thinking that we're going to see much, much higher implied volatility in FX markets, and we're going to see the idea of currency wars coming on. Who's going to be the net beneficiary of that? Of course, gold will be the place to be. We're already seeing big buying at the moment from gold. But as we look ahead to the week, I think we'll probably focus on the data from China. Will we see any gapping risk coming through? I'm not so sure. If you look at the Chinese manufacturing numbers, as I say, coming out at 11 o'clock on the weekend, you've got 49.6. That's not expected to see a material change there. The non-manufacturing numbers coming in at 53.7, or that's the expectations there. Will we see the Aussie, things like copper, having a gapping risk on Monday? I'm not so sure, but certainly that's something we will be keeping a firm eye on. Now, as we go through the week, let's break this down into countries. Let's start with America. We know that Donald Trump will enact the tariffs. We saw that 5 percentage point increase on the $250 billion. That goes up to 30%, barring any kind of surprise moves over the weekend. And that's something that we can't put out as well, the idea that potentially these tariffs could get pushed back. They could be there could be some sort of short-term truce again, given the sort of calming language we've seen over the last couple of days. If they do, then of course you could see a much more positive open on the Monday. But I'm still sure I'd be somewhat surprised if that was going to be the case. But we do know these tariffs on the 250 billion go up to 30%. The 110 billion tranche of goods go up to 15% as well. We also know that as we go through the week, we'll be looking at quite a lot of event risk from the likes of the ISM manufacturing number. The market's been very sensitive to that as a forward-looking indicator. Okay, in the US, consumer confidence has been pretty good. We saw in the GDP number consumption at 4.7%. But the early cycle warnings that we are getting to a more protracted downdraft in the US economy are starting to bite. And of course, that's why we've been seeing this inverted yield curve in 2s, 10s. 3-month, 10-year has been inverted for some time. My preferred measure is to have a look at the 3-month US Treasury, which is very correlated to the Fed funds effective rate, and have a look at how that's performing relative to the 3-month, to the 5-year forward rate, which is the market's interpretation of where the long-term neutral rate is, the rate that's no longer restrictive or expansionary. And we can see now that the short-term rate is about 51 basis points above. So the Fed effectively need to cut twice just to get down to what is considered a more neutral setting. So Fed policy, in my mind, is still too tight. Let's have a look at the Fed speakers through this week. We've got John Williams speaking on the 4th of September. Remember, last time that he spoke, he caused a kerfuffle in markets, suggesting or giving us a strong opinion that we're going to get a 50 basis point cut. Of course, then the New York Fed came out shortly afterwards and poo-pooed that idea. They've got a bit of a communication communication problem. The Fed, John Williams very much at the heart of that. And of course, Jerome Powell, he'll be speaking on Friday in Zurich. So that'll be something we're watching very closely. As you can see from my my prices table and my volatility chart, on the far right, if you have a look at what's being priced in, you can see the Fed with 109%. That tells me that we don't just have a 25 basis points fully priced in, but we've got a 9% chance there of a 50 basis point cut. Given what we've been seeing from things like consumer confidence, yeah, it doesn't seem like we're going to get a 50 basis point cut. If we have a look at inflation expectations in the US, the five-year forward rate, the swaps rate, is still around about 1.9% or just above there. So again, the Fed aren't going to be looking to cut by 50 basis points when inflation expectations are actually sort of grinding a little bit higher at the moment. As well as that, we've got, as I say, Jerome Powell speaking, ISM manufacturing numbers, I think they'll be quite a big one. And then on Friday, we've got the non-farm payrolls number. The market there is looking for 165,000 on the headline. The unemployment rate's expected to stay as it is. And of course, then you've got the hourly wages numbers, the sort of inflationary number that people look at, expected to grow at a 3% clip year on year. Will we see that dollar continue to move up? That's obviously something we're going to be watching. If you're having a look at euro dollar, not a huge amount to look at. We're going to be watching that CPI number that comes out early in the week. The estimate there, the market's expecting 1%, and then you get the European GDP prints as they go through the week. Here in Australia, well, you know, you've seen some pretty weak data coming out so far. We're going to see if that Aussie dollar can hold that 67 handle or where we actually break through. We do have the central bank decision, and that comes out on Tuesday, of course, at 2:30. Last month, there was very little moves after about 5 minutes. So, you know, we're probably seeing that again. Again, if you have a look at what's priced in, we've got about a 10% chance at the RBA cut at this meeting. If you go out to what's being priced out the curve, you can see 61 basis points of cuts being priced in over a 12-month period. You can see on that far right column exactly what's being priced into swaps over a 12-month period. You know, will these central banks live up to that? That's something that we're looking at the moment. The Federal Reserve obviously the market there pricing in 4 rate cuts over a 12-month period, but certainly 10% with the RBA not expecting any major fireworks there. As we go through the back end of the week, you know, we'll be looking at what happens in the likes of the GDP print as well. You know, given what we've been seeing from capex, construction, building approvals, all these various factors, one suspects we're going to get a fairly benign print on the quarter by basis. Have a look at the implied volatilities going through the market. As you can see on the ATM, the at-the-money implied volatility, Aussie yen is at nearly 13%. That's a year-on-year number. That's an annualised number, should we say. But that's taken within the weekly. So that's weekly implied volatility. So we're looking at what the market's telling us over the course of this period. And at 13%, Aussie yen is expected to have the biggest move. Now, that's partly a sort of a function of it being a very big proxy of risk around trade, but also the idea that we do have a lot of this Aussie data coming through as well. But certainly the market there is 12.94%. That's at 59 percentile. And that gives us a move in Aussie yen of around 112 points either way with a level of confidence of 68.2% if we're putting that into straddle pricing. Yeah, it does not surprise if you go down there to Aussie dollar, you can see that the weekly implied volatility at the money is 8.65%. So that's mid-range, 50 percentile. To give you an understanding of the implied move from now till Friday, the markets is saying with a level of 68.2% level of confidence that prices shouldn't really go much further than 60 pips either side of the current spot price. It doesn't scream that the market's expecting fireworks despite some of this data we're seeing coming through in Australia. What we also want to have a look at is what's happening in the pound. As you can see, sterling, Aussie and cable implied vols are creeping up. They're sort of mid-range in terms of percentile rank or implied volatility rank. We do like that just to give us a bit of context about where the implied volatility's been over the last 12 months. And we can see that just above sort of 10 and 12% in terms of the cable moves there. And yeah, I think that's going to continue moving a little bit higher. As we go through this week, of course, it's really all eyes on the Brexit situation. If you're trading pound, keep the position sizing, you know, very much in check. Do understand that you could have big headline risks coming through. Of course, Parliament comes back on the 3rd. We've got a very, very tight window to see what's going to happen. Are we going to see a no confidence vote being pulled on Boris Johnson's government, or will that no confidence vote be left until after the EU summit? Will we see the Remainers try and push through some legislation to be able to extend Article 50 and give them a bit more time to try and convince the EU to give them a bit more of a deal? I think if we saw that, then sterling could have a big move. You can see my commitment to traders report here. The markets are very, very short pounds. Risk reversals, the market's very, very pessimistic. You know, people have been buying up on that put optionality quite significantly. Or will we see something in the Scottish Parliament? But that period between the 3rd and the sort of 9th of September, you could see some fireworks coming through as the market tries to understand what this means with the proroguing coming through. So do have a look at this table. It gives you the expected moves coming through for the market, both on a 68.2% level of confidence, where we're using the straddle pricing, and also if I take the sort of moves out to a more outlier position, and we're using a 10 delta, which gives the market a statistical level of 90% of confidence that price shouldn't really move too much further on these G10 currencies there. So again, we're watching what's happening in the US. We're watching what the Fed say with the pricing quite low for a 50 basis point cut. We're watching the dollar. We're watching whether euro dollar can move a little bit lower, watching whether Aussie dollar can break through that 67 cents. And we can continue to keep an eye on what's happening in gold and also the pound. So definitely something to keep an eye on as we go through the new week.